Hello, welcome to our December 2025 Market Outlook and Positioning video. My name is Derek Varner. I'm joined today by my friend and colleague, Jeff Caber. Jeff, how are you?
I'm doing well, Derek. Thank you.
Happy Thanksgiving.
Likewise. Hope you had a good one.
So we'll start today with just a recap of what happened in some major asset classes during the month. As you can see on the screen, we had generally a positive month across bonds, large US companies, even small cap stocks up about 1%. Foreign stocks up about 1%. The one area that we saw a little bit of a decline was in the NASDAQ, which is primarily today dominated by large technology and communications companies. So we saw a little bit of a decline there. Jeff, any thoughts on the month? I know we experienced a good bit of volatility intra-month.
Yeah, and as you mentioned, Derek, you can see from the chart that we did have a big sell-off kind of towards the middle to late month, but a nice rally back. And I think a couple things that came up during the month that brought volatility back. The first is there was the government shutdown and took a while to work through that. Concerns about interest rates. Is the Federal Reserve going to lower interest rates another time this year? There were some doubts that came in. There were some headlines on private credit where there were some defaults and concerns maybe that could be a little more widespread than what people are aware of. And then finally, I think we had a little bit of a um, a risk sell-off where you saw small caps, technology areas such as cryptocurrencies, have a sell-off, but then rebound later in the month. So all those, concerns are still out there. Yes, we have a resolution for the government shutdown, but still the interest rates and some of the other things are still out there. But historically, December is a good time period for the markets. People hope for the Santa Claus rally. So hopefully we continue to move up from here.
Yeah, great. Well said. And so we'll talk about in this video a handful of the items that you described there. That some are partially resolved, some fully resolved, some not resolved at all. But in general, year to date, we've also seen very positive returns across many asset types. The S&P 500 through the end of November up about 17%. 18%. The equally weighted S&P 500, which basically normalizes for the effect of a company's market cap or size in the market, up about 11%, so low double digits there. Dividend stocks about 9%, small cap stocks up about 14. So we've seen a nice rally in small caps, which tend to be a little bit more economically sensitive. So I think we've seen positive rebound in expectations for economic growth, also a rebound in the expectation for interest rates to continue to decline as the Federal Reserve continues along its path of decreasing interest rates. And then foreign stocks, as we've highlighted in past videos, are just having a gangbusters year, primarily because of the decline in the US dollar, but also maybe some other factors like resolution of conflicts in Israel, potentially now in the Ukraine. So we're seeing some positive momentum there as well. And even bonds having a positive year up about 7.5%, which they've not had any great years in the last five to this degree. So some of the factors that I think have really led to the rebound in markets and the positive returns this year. Earnings have been very good. So this is the S&P 500. You can see that's fairly broad-based across a lot of different categories. But again, technology, communications, even financials are areas where we've seen a good bit of earnings growth and importantly, earnings surprise relative to what Wall Street had expected. Jeff, any thoughts that you want to interject on earnings season so far?
Yeah, I think one of the reasons why the market has been so resilient through all the different headlines and volatility this year is the solid earnings continue to come in. And I like to say if companies are earning more money, they're worth more. So that's been one of the major factors in allowing the market to be as resilient as it has been.
Yep. Yeah, stock prices follow earnings is the old adage. So well said. Other factors here that we've noticed, GDP, the US gross domestic product or our economic output as a nation is expected to run above long-term trends. And I think that's largely driven by the significant investment from artificial intelligence hyperscalers, as they're called, or companies that are really investing heavily in building out artificial intelligence infrastructure. But also, one of the factors that got resolved or partially resolved as a result of the end of the government shutdown was we started to get more unemployment data again, or employment data. So for the month of September, we saw an increase in payrolls of about 119,000, which was a little bit better than the past few months where we were close to kind of flatlining. And the unemployment rate is ticked up a little bit, but still below long-term averages at 4.4%. One of the continued challenges that we've experienced for the last few years, really as one of the last echoes of the pandemic era, has been continual higher costs. And so our most recent data point that we have from the Bureau of Labor Statistics is that inflation grew 3% year over year over the last year ending in September. Jeff, I believe, is it true that we're not going to receive an October report?
That's correct. They did cancel the October report, and the November report is not supposed to come out till December 18, and that's, due to the government shutdown and the delay of all the numbers coming out. And that kind of gets back to what I was saying a little bit earlier, creates some uncertainty because the Federal Reserve and the markets don't have as timely data as they historically have. So that leads to a little more uncertainty, potentially is the Fed gonna lower interest rates or not?
Right. And you might say, well, 3% doesn't sound like a lot, but what we've been experiencing is we've been in this 3% year over year inflation for, almost two and a half years now. Another way to show that is really that continual effect of rising cost of living. So here you see, the cost of living in this purple line has been kind of steadily marching higher, and we experienced a bigger jump than normal around 2022, and it's continued to kind of march higher at that 3% rate. The challenge is things like wages, on average, have not necessarily kept up, and things like home prices have really accelerated. So I think consumers and households are feeling more and more negative about their financial future, primarily because of higher costs and wages not keeping up with higher costs. And for a lot of folks that are younger in their professional careers maybe struggling to buy a home. So we see a University of Michigan Consumer Sentiment Survey here at close to its lowest level in recorded history because folks are primarily concerned about inflation. There might be other factors too, but that's a big driver when you read through the survey respondents. Jeff, what are your thoughts on kind of where we are with inflation and wages and sentiment?
I think people do feel really negative with all the headlines and everything happening, and that's reflected in that consumer sentiment survey. One thing we are seeing, just because unemployment is remaining low and people are, for the most part, remaining employed, retail sales continue to be strong and consumers are out traveling and spending. I think if you go to restaurants, you still see that, there's still waiting lines and there's a lot of economic activity. But on the other end, consumers are still starting to feel that pinch where their wages aren't keeping up with inflation, and we are starting to see a little bit of weakening in that area. But overall, consumers still seem to be resilient.
Right. Thank you for that positive balance to my. I wasn't trying to be overly negative there, but you as always you do a great job at balancing with the positivity. Thank you. So one of the other areas that I think is really interesting that we're watching with respect to the labor market has just been the kind of uniqueness of the time that we're in. There could be a whole host of factors like lots of folks going to college for decades, the advent of artificial intelligence. But what we've noticed here is that for the longest time, this blue line represents recent college graduates, and for the longest time, they tended to be more employable or have a lower unemployment rate than the average workforce. But really, since the pandemic, that environment has kind of flipped. And so, again, as I was saying, it may be because too many folks went to college for the last few decades. Not enough folks went to have a skilled hard trade. But what we're really noticing is more and more businesses are putting off hiring younger folks because they can do more with artificial intelligence. Things that in our industry, a junior stock analyst may have been tasked with doing now, artificial intelligence can help do some of that research. So I don't think it's a broad-based saying, oh, we're never gonna, we, the society, are never going to hire young people again. But I think that there's a delay happening. Jeff, what are you seeing, or what are your thoughts on this environment, which is, obviously very unique over the last 30 years?
Yeah, I definitely think AI has a big influence on what we're seeing there. The other thing is after the pandemic, kind of that 2021, 2022 time period, it was very difficult for employers to get enough employees. So I think one of the things we're also seeing is employers may not be hiring as much and they're holding on to their workers a little bit. So that may be a little bit of a factor there. But we definitely consider that AI is a big driver of that. I think that stock analyst example that you used, Derek, is perfect example.
Thank you. So we'll give an update here on valuation. Not a ton has changed month over month. When we looked last time, the last few months, we're seeing the S&P 500, which is the largest 500 U.S. companies, and it's weighted again towards those larger technology and communications companies that are really focused on artificial intelligence and the build out there. The investors are really enthusiastic about that part of the market, and it's pushing up the valuation of the S&P 500. So we're kind of at this level that we really haven't seen since the echoes of the pandemic, or during the pandemic and during the dot-com bubble. So that's an area where we're cautious. However, those companies, as we've said in past videos, are really generating a lot of cash flow and growth. So it's not an area where we're wholesale exiting, but we are increasingly cautious there. And then balancing that out, when we look at, again, the S&P 500 trading at its highest level in the last 15 years, tech stocks, growth stocks, kind of in the same. But when we look across the different parts of the market where we can build out diversified portfolios for clients, we see pretty reasonable valuations. This is a price to revenue, a price to sales chart to kind of normalize across different asset classes. But you see just the equally weighted S&P 500, pretty close to its long-term average, the average in yellow, the current in blue. Dividend stocks, the same. Mid, small cap stocks, the same. Foreign stocks and emerging markets, a little bit, elevated or close to their long-term average because they've had such a good year, but we still think they represent potential value. And you can see even at the top end of that range, which is over the last 15 years where those stocks have been depressed. Jeff, any thoughts on where we are today with valuations and building portfolios for clients?
Well, I think this just reinforces the diversified portfolio stance that we have right now, making sure that we do have, exposure to some of those AI technology related stocks, but also recognizing how overvalued they are. And, we've diversified a little bit over, I'd say, the past year and a half into more of the core dividend stocks, mid and small cap. One other observation for international, although they're at their top of the range over the past 15 years for price to sales ratio, just on a relative basis, the difference between US stocks and international, they still have a ways to catch up, just from a pure valuation standpoint.
Yep, exactly. So let's wrap up with kind of a summary of the economy and financial conditions in the market, and then we'll look at some portfolio tilts and themes that we've incorporated and advocate for. So, as we highlighted in the video, economic growth looks good, but it's increasingly skewed toward the build out of artificial intelligence infrastructure. So we're watching to see, if that trickles down to employment and household sentiment. So far, we list those as neutral for the reasons that we talked about. Employment is still okay, not great, not bad. And then households, as Jeff said, continue to spend, but are increasingly concerned about their financial futures. On the financial condition side, we see the U.S. Federal Reserve trying to lower interest rates. I don't think that's a guarantee at this point, particularly if inflation continues to tick higher. So we have this dial as close to neutral, but watching for positive signs with both interest rates and inflation. And then lastly, we just covered on the market, valuations mixed, earnings very good. And then Jeff, any thoughts on the trend? I know you closely follow market technicals. Are we in a bull market? Is that what we're in now?
Yeah, I think the longer term trend is still intact, positive. We did have a couple blips this year. The first one would have been April, the big sell-off after Liberation Day. But once again, the market was resilient and rebounded there. I'd say most recently, we did have some of the shorter term technical signals that we follow move to a negative trend, but they've come back up towards the end of November. Now we're kind of close to resistance in those areas. So December will maybe be a tell for some of the shorter term technical indicators, but definitely the longer term indicators, we're favoring the risk assets.
Gotcha. So still on the long-term trend is positive, and use the word resistance, short-term resistance. So that's almost like a ceiling. Is that the way we should think about that?
Correct. So if you think about the market traded up maybe in October to a certain level, we had a sell-off, and now we're getting back up to that level. We want to see if there's enough demand in the market to exceed those previous tops that we had,
Mm.
and that would show that there's more money coming in, more of an appetite for risk is continuing with the longer term trend.
Gotcha. So if we break above that resistance or that ceiling, that would be a very positive sign.
Exactly. Yep.
Got it. Okay. And then lastly, some portfolio themes. I think, we've talked about these in past videos, but an emphasis on diversification within stocks. So not just owning the S&P 500, which has helped portfolios this year, in our opinion, owning things like international stocks, for example. Alternative assets, just to try to add diversification and reduce volatility in portfolios. So these are things like hedge fund or hedging type strategies. Within bonds, we really, because we do have concerns about the potential for a reacceleration of inflation and higher interest rates, we've really kept, for the most part, fixed income very vanilla and shorter duration. And then commodities as a hedge, again, against higher costs. So commodities would be things like industrial metals, agricultural commodities, energy commodities, et cetera. And then one of our key themes that we've talked about for a while, which has done quite well this year, is biotech or innovative healthcare companies that are trying to cure diseases. So those are some of the key themes in portfolios, but every client portfolio is different based on their unique circumstances and goals. So we welcome the opportunity to speak with you. We'd love to connect about the markets, the economy, your portfolio, your goals. Please reach out and we'll schedule something. But thank you for watching this video. This will be our last one for 2025, and then we'll see you again in early 2026 with our outlook for that year, believe it or not. So thank you for watching. Jeff, thank you for being my guest this week
Of
and
course.
this month. And I appreciate your wisdom and your advice. Thank you.
Likewise. Thank you, Derek.
Okay. Have a great month, everybody. Happy holidays.